Okay, so chapter 14, we've talked about equity. Now we're going to talk about debt financing. And the thing about debt financing, probably the hardest thing that we're going to have to do here is we have to get the present value of the debt, so the bonds and the uh, long long-term receivables there, um, the notes payable. But again, I built you guys a handy dandy spreadsheet, and I hope that it will help us figure some of that out. Don't worry about trying to figure out the spreadsheet yet. We'll walk through it in just a minute. Hi, why will it not let me close that thing? Yeah, I know. I don't have volume on. Okay. That's frustrating. There we go. All right. So let's talk through some stuff, and we'll do the same thing we've been doing. We'll talk a little bit. We'll go to the in-class activity. We'll talk a little bit more. Okay. Some things that we probably need to understand first. Let's talk about leverage. So capital structure is simply how a company is going to fund itself. Are we going to use owner money, equity? Are we going to borrow money, debt, or are we going to have some kind of mix of both? And that mix matters a lot. So here's where it kind of gets fun. Financial leverage is the idea that if you borrow money and you invest it wisely, meaning you earn more after tax, your shareholders will win. Your return on equity will go up, and that makes everyone excited. But, and this is why it's a double-edged sword, those financial liabilities, they are real contractual obligations that you have to pay back. So debt doesn't care if your sales had a bad quarter. You still have to pay it back. So leverage can amplify profit, but it can also amplify some problems. So why would a company choose something that's going to amplify potential problems? Why would we choose long-term debt instead of issuing stock? Because sometimes debt's actually the smarter move. Um, First, sometimes that's the only option. If a company is small, closely held, doesn't want to dilute ownership, issuing new stock may not even be realistic. So for small companies, sometimes stock's not even an option there, right? If you're not a public company, you can't really issue a lot of stock, doesn't work that way. But a bank, a bond market, that is a lot more accessible. Second, debt usually has a lower cost of capital than equity. Lenders take less risk than shareholders, and so they get paid first. They don't share in upside profit, so they're willing to accept a lower return. That makes borrowing cheaper than giving up ownership. Third, there's some tax advantage. Interest expense is tax deductible. Dividends are not tax deductible. So if a company pays $1 million in interest, that reduces taxable income, and that tax shield lowers our effective cost of borrowing. Equity doesn't get that benefit. If we pay $1 million in dividends, we don't get to take that off our taxes. Fourth, no voting rights. Debt does not carry voting rights. When you issue stock, you give it partial control, right? So if I have a business and I give everyone in here a piece of the business, if everyone in here has some stock of the business, everyone has partial control. If they're if it's not stock, if it's just debt, if you're debt holders instead, if I promise to pay all of you back like the $1,000 you've loaned me, I still have all the control and you guys don't get to vote, right? You just get to be paid later. So management can raise capital without giving up control of the company. And finally, leverage. Debt creates financial leverage. The company earns more on borrowed funds and it pays an interest. The excess return boosts return on equity. And shareholders like returns on equity to be boosted. So let's talk about some terms you're going to hear while we go through this chapter. This is like our bond vocabulary survival kit. So let's build this step by step. First and foremost, what is a bond? A bond is simply a long-term IOU. A company says, lend me money today. I'm going to pay you interest along the way and repay the full amount at the end. That's it. It's formal borrowing from investors instead of a bank, basically. When we talk about bonds, everything revolves around face value. Face value is also called par value. That is the amount the company promises to repay at the end. So if the bond says $100,000 face value, that's what gets paid at maturity, regardless of what investors originally paid for it. Which brings us to maturity date. This is simply the due date. It is the day the company must repay that face value. Think of it as like an expiration date. Okay. Here's where people sometimes get a little bit tripped up. The contract rate, also called the stated face or nominal rate. I think in our spreadsheet, I call it the stated rate. I just lost my place in my notes, and that's not good. There's a lot of notes. This is the interest rate that is written on the bond. It determines the cash interest payments. So if you have a $100,000 bond with a 6% stated rate, the company pays $6,000 a year in interest. That rate does not change once the bond is issued. The effective rate can change, the market rate can change, but the stated rate does not change. Next, we have bond certificates. This is basically the official proof of ownership. It lists the face value, the interest rate, the maturity date, the key details. Think of it like an ID card for the bond. Finally, the bond indenture. This is the big legal contract that outlines the rules, the rights of the bondholders, the obligations of the person who issued the bond, any restrictions, covenants, any special provisions, anything that could happen if things go wrong. This is the document that everyone turns to. So we have an amount to be repaid, the face value, a timeline, our maturity date, an interest rate, the contract stated or nominal rate or face rate, proof of ownership, the certificate, and the big legal governing contract, the bond indenture. There are different kinds of bonds. Not all bonds are built the same. Companies design them strategically depending on risk, flexibility, investor appeal. So let's go through the different kinds of bonds we might see. Oh, that's like going off the slide. Oh, no, it's just on the back screen. Okay. Like it's going off the side of the screen back there. We have debenture bonds, and these are unsecured bonds. That means they're not backed by collateral. No building, no land, no equipment. What backs them is the company's reputation. Investors buy this type of bond because they trust the company's financial strength, its history, its profitability. Maybe they have really positive cash flows. If the company goes bankrupt, debenture bond holders stand in line with general creditors. So higher risk than secured bonds. They have to offer a higher interest rate to attract investors. Mortgage bonds are the opposite. They are secured. They are backed by a lien on a specific property, usually land or buildings. If the company defaults, the bondholders have first claim to that property. Lower risk because there's collateral attached. Zero coupon bonds, and these are kind of weird ones. They don't pay periodic interest. There's no semi-annual checks being written or cashed. Instead, they are issued at a very deep discount, well below their face value, and over time, interest accrues, and at maturity, investors receive the full face value. So you might pay $600 today for a $1,000 bond and no payments along the way, and at maturity, you get $1,000. Your return comes from the difference. Callable bonds. These give the company flexibility. A callable bond allows the issuer to repay the bond early at a predetermined call price, usually at a premium. Why would a company do that? If interest rates drop, if a company issued bonds at 8% and rates go to 5%, they might call the old bonds and refinance at a lower rate and issue new bonds that have a lower interest rate. Convertible bonds are hybrids. They allow bondholders to convert their bonds into predetermined number of common shares. So investors are still bondholders. if the stock underperforms, but there's a potential upside if the stock rises. A little more money back there. And then serial bonds. These mature in installments. Instead of one large maturity date, the face value is paid out over time. Bonds have to be issued. So let's pull back the curtain on how bonds actually get issued. This is where accounting kind of meets finance. First big idea. When a company wants to issue bonds, there's two main paths. They can sell them privately, maybe to a pension fund, an insurance company, or an institutional investor, or they can go public. If they go public, they're going to hire an underwriter, like an investment bank. The underwriter is kind of the middleman. The underwriter agrees to a price, buys the bonds from the company, then resells them to investors. And for that wonderful service they do, they earn a fee. So the company gets its cash up front. The underwriter handles distribution risk. But let's talk about something critical, and that is how the selling price is determined. It is not random. It depends on the stated contract or interest rate, the time to maturity, the overall bond market, the company's credit risk, the economy. And this is where sometimes we get confused about the contract rate and what we have called the effective rate or the yield. The contract rate is not necessarily what investors demand. The effective rate is the market rate, and that's the rate investors require based on current conditions. So, if the contract rate is equal to the market rate, the bonds are going to sell at face value. If the contract rate is higher than the market rate, bonds sell at a premium. Contract rate is lower than the market rate, bonds sell at a discount. Let's talk about that just a little bit more. The selling price of our bond equals the present value of all of its future cash flows. So, how to figure out those cash flows? We're going to take our periodic, and we're going to have our periodic interest payments, the principal or face value repaid at maturity, and we're going to take both of those and discount them back to today using the effective interest rate, the market rate that our investors require. That's going to give us our selling price. And again, we can sell at par, which effective rate equals market rate. We can sell at a discount, or we can sell at a premium. So, bonds issued at par. Let's look at an example before we jump into some things on Cengage. The full bond pricing example. So this is where everything we just talked about should kind of click together. We have Pine Company, and they issue a $100,000 5-year bonds. They pay interest semi-annually at a 12% contract rate. The effective market rate, also 12%. Right away, because the market rate equals the contract rate, we should expect the bonds to sell at par. Okay? But we're still going to prove it mathematically. So step one, we're going to convert everything to semi-annual terms. Now, some bonds don't have semi-annual terms. Some have quarterly terms or monthly terms or yearly terms, right? And so all we're doing is breaking it down into the number of periods that the bond is paying interest. Because interest in this one is paid twice a year, we're going to adjust our rate. So we're going to take our rates, 12%, divide it by the 2 periods a year. So for every semi-annual period, we have a 6% rate. We're also going to have to convert the time to semi-annual periods. For a 5-year bond, there would be 2 periods each year. So we'd have 10 semi-annual periods. If it was quarterly, there would be 20. If it was monthly, there would be what? 5 times 12 was 60, right? And then we figure out our selling price. We're going to figure out the present value of our principal So $100,000 times this weird number. This weird number is from a present value table that's in the spreadsheet that we're going to look at in a few minutes. We're going to figure out the present value of interest payments. And these are a little bit different. This is the present value of a single number. And this is the present value of basically an annuity that you get paid over and over and over and over again. So they're set up differently. So that's why our numbers here are different. We add those together, they equal 100,000, which is the face value of our bond. If our bond sells at a discount, same process to get to the selling price, present value of the principal, present value of interest payments, add them together for the selling price, take our face value minus the selling price, and we get our discount. If it sells at a premium, same exact process, but selling price minus face value gives us our premium. So, three possibilities: premium, par, or discount. Yield or effective rate is less than contract rate on a premium. Yield equals contract rate on a par. Yield is greater than contract rate on a discount. For interest, for premium bonds, interest expense is less than interest paid. Par, interest expense equals interest paid. Discount, interest expense is greater than interest paid. So now let's talk about the journal entry we're going to do. How do we actually record our bond? Let's make this as simple as possible. At the moment the company issues bonds, two big things are happening. The company is going to receive cash, and the company is going to create a long-term liability. So the base entry is always going to start the same. We're going to debit cash, and we're going to credit bonds payable. We're going to debit cash for the amount received. We're going to credit bonds payable for the face value. Bonds payable is always recorded at face value, not at the selling price. But what happens if we have a discount or a premium? If bonds are issued at par, again, just debit cash, credit bonds payable, done, no extra accounts. At a premium, we're going to debit cash, credit bonds payable, and we're also going to credit premium on bonds payable, our excess. At a discount, debit cash, debit discount on bonds payable, credit bonds payable. So what those would look like with our $100,000 example. Sometimes bonds are not issued at the first of the year. So they can be issued between interest payment dates. So we have a situation here that most bonds pay interest every 6 months. And let's say the interest dates are January 1st and July 1st. But the company issues the bonds on March 1st. That means 2 months of interest have already accrued since January 1st, but no payment has been made yet. So who should receive that interest on July 1st? The investor who holds the bond on July 1st. But even though the investor didn't own the bond for the full 6 months, and we have to fix that. So how do we fix that? Let's look. Maple Corporation issues an $800,000 10-year bond dated January 1st, year one at par. Bonds have a contract interest rate of 12%, pay interest semi-annually on January 1st and July 1st. On March 1st, because 2 months have elapsed since the interest payment date prior to the sale, Dennis collects $16,000 accrued interest in addition to the face value as follows. So he's going to have cash plus some interest expense and then an $800,000 bond payable. Dennis is going to record the first semi-annual interest payment as follows. So he's going to record his interest payment as normal. We've credited interest expense here. We're debiting it here. So it's going to even out. All right, let's go to Cengage. We have several of them we're going to do together in a row here that all have to do with issuing bonds. Oh my gosh, my screen just got huge. Okay. Oh no. Come back. There we go. So you need Cengage. You also need a spreadsheet. I'm going to try to make this all fit on the screen nicely here. On our spreadsheet, we have some places to enter in information. We have some different colors. Anything that is a green square is a number that you can type in. Anything that is a blue square is a drop-down box for us to pick what's going on. Okay. What it's going to give us is the factor we need to use from this giant set of tables for present value. It'll help you figure out which table to use, and it'll actually pull up the number for you. So, make that bigger. On January 1st, year one, I don't even know how to say that, Canglon Inc. Conglon issues 10% 5-year bonds with a face value of $150,000 when the effective rate is 12%. Interest is to be paid semi-annually on June 30th and December 31st. Prepare calculations to prove that the selling price of the bond is $138,959.90. You can click there for the tables if you want to, but the tables are the same ones in your spreadsheet. Round your answers to 2 decimal places if necessary. Okay, we already know the selling price. Selling price, $139,959.90. It tells us that. We need to figure out the present value of the principal and the present value of the interest. So over here in our spreadsheet, we're just going to start entering in the information that we know. Try to make that big enough that I can see it. Okay. I did 139. 138. There we go. Okay. So January 1st, year one, all that's good. Start with our face value, $150,000. So I'm going to put 150,000. Our stated coupon rate, 10%. Change that to 10. Our market or effective rate is 12%. Our bond life is 5 years. We've already got that in there. Number of times interest is to be paid. Interest is to be paid semi-annually. So on this yearly one, there's a drop-down arrow, and we're going to click semi-annually. Your spreadsheet has now calculated for you the number of periods in those 5 years that gets paid out, the stated rate per period, the effective rate per period, and the interest per period. That's nice. For the principal, we want present value. This will also do future value, but I don't really think anything we're doing does future value right now. But present value, our cash flow type for principal is always single sum. And if you pick single sum, you don't have to change anything with timing. If we have an annuity, then we'll change the timing. But single sum, we're going to make our rate the same effective rate we have here. Enter in rate drop down below. There's a drop down box for you to pick. Oh gosh, I can't see that. Is it this one? Okay, thank you. The reason it's a drop-down box is because it's set up very specifically in the table. That way you guys don't have to worry about typing it in incorrectly. Just pick the number from the drop-down box. Periods. We have 10 periods in this. So I'm going to pick, I can see that even less. Thank you. And then amount. We're specifically working right now with our face value. So we're going to put the same amount as we have above. It's going to tell you which table to use. Table 3, present value of 1, if you wanted to go to the table yourself. But it's also going to give us the factor from that table. And that factor is where our 6% and 10 periods meet for present value. and the result of 150,000 times that factor. So this $83,759.25 is the present value of our principal. We're going to do the same thing now for our interest. We already have all the information up here in. We just need to change a couple things down here. Interest is treated as an annuity because you're getting multiple payments over time. That's what an annuity is, right? Present value is fine. We keep that there because we're discounting this back to today. We're going to change single sum to annuity, and this is just an ordinary annuity. So we don't need to change that. We do need to change the amount though. The amount, what we're getting paid, the interest we would get paid per period, $7,500. We need to put that in the amount here. There's probably a way for me to have coded that in there, but I didn't. Okay. Tells us what table to use. Table 4, present value of an ordinary annuity. And it tells us the factor, 7.360087, which gets multiplied by our amount, and that gives us the present value of our interest. You can also, there's a formula that Excel can do that just figures this out for you. But it's not always rounded correctly. And I want to make sure we were matching what our book had. There's an explanation down here. We're using table 4, and it's giving you all of the things that you did. If someone wants to add those up, that looks right, right? Yeah, that looks right. So there's our amounts. Now we're going to do the journal entry to record some things that have to go along with this. Next. Prepare the journal entry to record the first interest payment on June 30th, year 1. I'm going to go to General Journal. To record our interest payment on June 30th, we already have what the cash interest is going to be. It would be $7,500. We have figured out on the one we did before. Oh, we should have written that down. Let me pop back the things here. So we just need to change that to single sum, I think. Yeah, and the amount. Thank you. Okay. Oh, no, I'm sorry. I need the whole amount. That's why that looks weird. So we pull all the key facts. We have all that in there already. We know the interest to be paid on June 30th is $7,500. We know from what we did before, just a minute or two ago, that $139,959.90 is our selling price. We need to multiply this total selling price times the stated rate for the period. No, I'm sorry, the effective rate. I'm looking, why am my notes are wrong. Oh, I'll fix this later. Okay. Multiplying our selling price by the effective rate for the period, because that's the interest we're getting paid, right? Stated rate is what it is when it's started. Effective rate is what it is now. So $138,959.90 times 6%. And we can make a little thing down here that'll do that for us. Let's do present value of principal. So we have that. These would be numbers we would have to type in, which is fine. Present value of interest. And selling price. Are these two things added together? Oh, not percentages. That's bad. Don't do that. Oh, go back. Okay, there we go. So our interest expense, what we want to get. We're going to take our selling price times way up here, the effective rate per period. So our interest expense, $8,337.59. We're not quite done yet, though. We need to compute the discount amortization on this. Actually, we could just call it the amortization. What? Hold on. Formula text. So we're taking the selling price times our effective rate per period. The amortization is the difference between the interest expense and the interest, I keep saying interest. The interest expense and the interest paid. So interest expense minus the interest per period. So $837.59. So our journal entry on June 30th, we are going to debit interest expense for the amount of interest expense we have, $8,337.59. Because our interest expense is more than our interest per period, we have a discount on our bonds payable. So we're going to credit discount on bonds payable. And the amortization is the amount we're going to credit, $837.59. And then we're going to credit cash for the amount of interest per period. On number 3, we're going to do a similar thing to what we did on number 1. So sending data to the server, and I can go on. So we're going to use our spreadsheet again. January 1st, year 1, Lightfoot Corporation issues 10% 5-year bonds with face value of $275,000, effective interest rate of 9%. Interest is to be paid semi-annually. Prepare calculations to prove that the selling price of the bonds is $285,880.07. Okay. So let's enter in our information again. 275,000. Our stated rate is 10%. Our interest rate this time is lower. It's 9%. Oh, I didn't change that. 5-year bonds paid semi-annually. So that means we have 10 periods. 5 times 2 gives us 10. Stated rate per period is 5%. 10% divided by 2 is 5. Effective rate is 9%. 9 divided by 2, or sorry, is 4.5. The interest per period, $13,750. We're already set up to do the present value of the principal, so let's do that. Present value is there, single sum. Let's change our rate to, see, enter in rate drop down below to 4.5. Our periods are already correct, and we'll change our amount to 250, nope, sorry, $275,000. And we get $177,080, $177,080.20. I'm going to put that down there just so we can check all of this in just a second. Still have everything all set up, and now we need to do the interest. And again, we're changing from cash flow type single sum to annuity because we're getting paid interest over and over and over again, or we're paying out interest over and over and over again. And it's an ordinary annuity. Rate's fine, period's fine, but we need to change this interest per period to 13,750. Nope, I still typed it wrong. Just looking right at the number. There we go. Tells us what table, what factor, gives us a result of $108,799.87. And we'll put that in down here as well. 108,799.87. We add up to $285,880.07. So we added our mathed correctly. Journal entry for this particular one, we're going to again record the first interest payment on June 30th, year 1. Oh, I went too far. Let me go back. So this time our amortization is negative. Probably over here to the side, we want to write, if positive, discount. If negative, premium. Just to help remind us when we do our journal entry. This isn't really a negative number, but if we don't do that, we'd have to go in and change that formula every single time. That's annoying. We don't want to do that. So, July or June 30th. Start the same way. We're going to debit interest expense for the $12,864.60. 864.60. When we have a premium, though, we're going to debit premium on bonds payable for the $885.40. And then our last part is going to be a credit to cash or whatever the total amount was, 13,750. So our journal entry, the first interest payment at a premium. Number is this number 5. January 1st, year one, North Company issued $2 million of bonds with a stated rate of 10% due to mature December 31st, year seven. Pay interest semi-annually. The market rate of interest was 9% at the date of issuance. So let's get some stuff in here. Face value, $2 million. Coupon rate is 10%. We already have that. Market rate is 9%, but periods now, it's a 7-year bond. So we're going to change our bond life years from 5 to 7. Our periods go up to 14. Our interest per period is $100,000. That's nice. Prepare the journal entry for the sale of the bonds on January 1st, year one. So we still need to figure out the present value of the principal and the present value of our interest. This time we're already set up for our present value annuity, which is the interest. So let's go ahead and do the interest first. Periods, we need to change to 14. And we need to update our amount from 13,750 to 100,000. We end up with, is that right? Hold on. There's a double check. Yes, that is correct. Okay. $1,022,282.50 of interest. So that's what I'm going to put in here. 1,022,282.50. That just seems really high, but we are working with $2 million here. Then we can get the present value of our principal. Only thing that needs to change is we're going to go from an annuity to a single sum. We're going to change the amount from 100,000 to 2 million. Tells us what table to use if we want to look it up ourselves, the factor to multiply $2 million by, and the result is 1,079,946. That looks right to me. 1,079,946.00. So our selling price should be $2,102,228.50. Last thing we need to kind of add in here to our spreadsheet. Difference in face value and selling price. Our selling price, $2,102,228.50. Our face value, $2 million. So we're selling our bonds for more than they are worth. We're selling at a premium. So opposite of what we had here. If positive, premium. If negative, discount. Again, just notes to help us when we do our journal entry. Last journal entry we're going to do today because we're going to run out of time. When we sell the bonds on January 1st, we're going to get cash. Oh, I don't have to write debit cash. Cash. The actual cash we're going to get is the selling price. 2,102,228.50. We're going to credit our bonds payable account for the face value of the bond, $2 million. Bless you. And then if it's a premium, we're going to credit premium on bonds payable for 102,228.50. Okay, and that is where we're going to stop for today. Monday, we will probably not get through all of chapter 14. We'll try to get through most of it. So Monday and probably Wednesday next week, we'll get through chapter 14. Friday, we'll go over any questions on the chapter 14 homework. And then there will be a midterm that will open up on D2L and be open for a long time. Not D2L, on Cengage, for you guys. That's it for today. Have a great weekend. Enjoy it. It's supposed to be really nice tomorrow.